unfortunately, you can't diversify yourself out of a market downturn. Boy, that'd be beautiful if we could build a portfolio that would never go down regardless of how scary the markets get. But that doesn't mean that you shouldn't diversify. And in today's video, I'm going to share with you two things. One, why you cannot diversify and protect yourself from all market downturns. But then, just as importantly, why diversification is still important. It's not going to protect you. It's not going to insulate you entirely from a market downturn, but it's still going to serve you very, very well in your investments and over time. So let's go for a little walk in this beautiful location and let's talk about it. So the reason you can't diversify away from a market downturn is you might have assets in your portfolio that move in opposite directions of one another. You might have one that's going to move up by 2 units of value and another one that would only move up when the market's doing well by half of a unit of value. And that's called correlation, how much your different stocks, your different investments move based on what's happening in the marketplace. So if an asset moves relative to another one more, if one goes up by 1% and the other one goes up by 2%, that's a positive 2 correlation. And if another one moves down when the other one moves up, that's called the negative correlation. And it's an important thing in the long-term strategy of developing and building a portfolio, but it's not going to protect you from a scary time like the 2008-2009 financial crisis, and it's not going to protect you from like the early days when COVID first came to the United States and the markets dropped. It was the fastest drop ever in United States history. 30% drop, a little over 30% drop in a very short period of time. And diversifying your portfolio is going to help, but it's not going to eliminate all the pain. And here's why. It's called correlation breakdown. In the examples I just gave you, a correlation of 2, something's moving 2 times more than the other, or one moves down when the other one moves up. During scary times, investors act irrationally, and a lot of investors are doing exactly the same thing at the same time. So that correlation, those past patterns, don't hold up. And one of the things to remember is correlation is based on what's happened in the past. And we all remember the SEC, the advertising warnings that past performance is not indicative of future performance. And that's exactly why correlation breakdown happens, is because, we don't live in a perfect world, and what happened in the past is likely not going to happen in the future. If only it were that easy, my job would be super easy, right? But it's not. It'd be nice to just be able to look at the past and say, okay, we're going to use this to protect ourselves. But just because you cannot use diversification to totally insulate yourself from a market downturn, it can help. And that's a really good reason to have diversification. But at its essence, why do you have diversification? And essentially, it's because you don't know which one of your investments are going to do well or which one might be facing headwinds in the future, right? It is your protection against ignorance. It's your protection against not having perfect information. It's your protection against not having a crystal ball, if you will. So diversification still makes sense, right? If I had 10 exchange-traded funds, and exchange-traded funds is just a basket of stocks. For instance, you could own a biotech ETF, which might have 30 different biotech companies. I may not know which biotech company is going to do the best, and so I might just use a low-cost exchange-traded fund to get that exposure. But if that's my only investment, boy, I'm really going to be hurt if over 10 years biotech faces headwinds. Let's say there's new regulations or just something makes it more difficult. It's harder for them to raise money for whatever reason. Things can go wrong, and they can go wrong for a period of time. So diversification allows you to benefit even if you have biotech. Maybe you also have emerging markets, and you also have foreign exposure. You also have U.S. small caps and U.S. large cap companies. And because you don't know which one's going to do well, but you think over a 10-year period they're all going to do well, diversification can still help you in that category. So that's why you still have diversification. Now, there are some things that can protect you from market downturns, but it's not diversification. Diversification is going to help some, but it's not going to get you completely there. In fact, the only way to have complete protection against market downturns is to have a guaranteed return, right? So that would be things like at a bank account. You know, your bank says currently now you can get non-refundable CDs, not at all banks, but at some banks for 3 to 4%. That's a pretty decent rate. And the only reason they're doing that is because they can reinvest your money at a higher rate. And frankly, because of what happened to Silicon Valley Bank recently, some of the regional banks are having trouble attracting deposits. So that's one of the ways they do that. So if you've got an FDIC insured bank deposit and you're within the FDIC limits, you know, if the market goes down 30%, you're still fine, right? But the problem is you're probably going to dramatically underperform. I don't know. I don't have a crystal ball, but you're likely going to dramatically underperform over a 10-year period versus having a diversified portfolio. So that's one way to protect yourself from a market downturn. The other way you protect yourself from a market downturn is to protect yourself from making silly mistakes, from getting emotional, from selling your stocks when things are the scariest after there's been a downturn. So one of the best things you can do for yourself is make sure you have a allocation between stocks and bonds is kind of the high level. That's right for you, that you can withstand scary times in the marketplace. You know, typically, you know, for a lot of people, this is not financial advice, but there are a lot of people that have what's called the 60-40 portfolio. 60% in stocks, 40% in bonds, particularly as they get older. But what happened when interest rates started going up, what happened kind of recently is the stocks went down, but then on the bond side, a lot of people got hurt because their bonds, because interest rates went up. Nobody wanted the value of their lower interest paying bonds went down. So it's not as simple as just saying 60-40 and you're done. So I think for a lot of people, they benefit from having somebody by their side to help them construct a portfolio designed to meet their goals, and then to also be a river guide, to be a confidant during scary times in the market. And the answer you want from a financial advisor, and I'm a fan of fee-only financial advisors. You can find one by Googling that term and find one near you to work with. But you know, one of the things that I think an advisor can really help you with is helping you come up with a game plan before you need it, right? Oftentimes during a market downturn, clients will call and say, well, you know, the market's down, you know, 10% in the last 3 weeks. You know, what are you doing to protect me? And I think the best answer a financial advisor can give you is, what we're doing to protect you is the work that we did for you 3 years ago or 5 years ago, coming up with this long-term game plan that'll allow you to ride out this volatility and still be comfortable that you're going to reach your long-term goals. So that's the video on diversification. It makes a lot of sense to diversify, but have reasonable expectations. Unfortunately, no portfolio other than FDIC government, the government insured bank products can keep you 100% from risk. Even, you know, people will say, well, annuities can do that. But you got to remember that annuities are contracts with the company. So like during the financial crisis, there were annuity companies that were also at risk of going under. And, you know, there's a lot of regulations around annuities. So, you know, ultimately folks probably would have been okay. But there's no guarantees. So unfortunately, I wish there was. If there was, I would share it with you. So I hope you found this video helpful. If you did, as the kids say, thumbs for likes, subs for love. If you're enjoying this channel, subscribe, leave me comments. I do enjoy watching the comments. And until next time, I'm Azul, encouraging you to take full advantage of the youth of your senior years. Remember, you're only young once. Let's use our time wisely.